Welcome to video lecture 6.4. I'm going to do this particular learning objective in two parts. So we're going to be talking about the percentage of completion and completed contract methods. These are the methods that are used for long-term projects that allow companies, at least for the percentage of completion, allows a company to recognize revenue and profit ahead of the delivery of a constructed product such as a building or a boat, a ship, airplane, something that's going to require a long lead time. It can also be used, say, for the construction of an information network. So we're going to look at this area, which is unique to several industries, particularly the construction industry. GAAP has two methods that are allowable. Companies, for financial accounting and for income tax, must use the percentage of completion method unless it is impossible to make certain estimates that are required to use the percentage of completion method. Let's go over and take a look at the code. And this is code section 605.35.25, which deals with long-term or construction type projects and the recognition. And in this section, they talk about the two generally accepted methods, the percentage of completion and the completed contract method. And it says that companies should evaluate closely which choice that they make, and once that choice is made, all similar types of projects should be accounted for. So if you have a construction company and they choose the percentage of completion, then they should use that for all of their construction type projects. And here in paragraph 57, it states that um, the 56 and 57, uh, that the use of the completed contract method depends on the reliability of the estimates that you are making. And given the nature of the construction industry, making these estimates is typically not a far stretch. Projects are closely managed and cost estimates are continuously updated. So most contractors will use the percentage of completion method. The only time you use completed contract is if you cannot make estimates of the cost that it will take to complete the project, or in some very extreme cases, typically involving projects that are research related and are kind of open-ended, you cannot establish an actual contract price. Here, contractors would be reimbursed on a cost-plus basis, uh, and often it is difficult to estimate both the revenue and the cost for those projects. But again, these are very rare. The Internal Revenue Service requires people to apply to use the completed contract method because this delays the payment of tax into a future year. In an audit investigation I was involved in up in New York City for the Second Avenue subway, contracts were let in the billions of dollars, and contractors chose the completed contract method. And since the contract was at that time had been underway for 15 years with no sign of completion, had never recognized the income derived from those projects, even though they billed and collected on them. That was one of the types of projects that raised the attention of the Internal Revenue Service, and in their regulations, they require companies now to use the percentage of completion method unless there are extreme circumstances and the company has to apply and get approval for the completed contract method. We're going to focus in on the percentage of completion. But the completed contract method is very straightforward. As a construction project is ongoing, all costs related to that problem for labor, material, subcontracting goes into an asset account. All billings, of course, are going to be increasing our accounts receivables, and any cash collections will reduce the receivable. And the difference between the costs that we have accumulated in our construction in progress minus the cash collections will result either in having surplus costs, in which case this would be called an asset, or it would, if our costs are less than our billings that we've made, then we would have a liability for unearned revenue. Let's take a look at some of the things that we're going to need to do to use the percentage of completion, which of course is the method where most contractors will be using. Here I have four formulas that, or four groups of formulas that are required to account for a project under the percentage of completion. The first one we begin with is to determine the actual percentage of completion. And to do that, we take the total costs incurred to date, and of course this could go over several years, and divide the estimated total cost to complete the project. So the estimated total cost to complete the project is a key amount. That is the cost we've incurred to date plus our estimated future costs. And again, we'll take the cost incurred to date and divide it by that estimated total cost, and that'll give us our percentage of completion. And this is an estimate. This is an accounting estimate. And we have to go back and revisit this on an ongoing basis. And if it changes, we will apply any change from the time that we've made the determination of the change forward. We do not have to go back and restate any financial statements. We're going to take this percentage of completion and use it to calculate two things: the revenue that we can recognize to date and the gross profit we can recognize to date. And to do that, we take the percentage of completion and times it by our estimated revenue. Our estimated revenue is our contract price plus any approved change orders. For our purposes, the contract price that's spelled out in the problem is the estimated revenue. In the real world, there are change orders that would make this a changing amount as time progresses. For our gross profit to date, we take our estimated gross profit, which is our estimated revenue, minus our estimated total cost. That will give us our estimated gross profit. We'll take our percentage of completion, multiply it by that to come up with the amount of gross profit we can recognize to date. After the initial period, we will need to make the calculations here in number 3. And these are for the current period revenue and current period gross profit. We're going to take the revenue recognized to date that we calculated in number 2 and subtract out any revenue recognized in prior periods. So in year number 2 of a contract, we would subtract out the revenue we recognized in year 1. And this would be a cumulative amount. So in years 3, the revenue recognized in prior periods would be the revenue in period 1 and in period 2. And of course, the total revenue that we can recognize to date minus the prior gives us our current period revenue. And we'll do the same thing with gross profit. We'll take the gross profit recognized to date and subtract out any prior period gross profit to come up with the current period. In number 4, we have our calculation of 2 balance sheet accounts. The first one deals with a comparison of our project cost and gross profit to date against our billings to our client. So we're going to take the project costs, which is the estimated cost up here, and our gross profit to date, which we've calculated here, and subtract that and take our billings to date, subtract the billings to date, and if we have a positive amount, that is our project cost and gross profit is greater than our billings, then we have an asset that is called cost and profit in excess of billings. If our project cost and gross profit to date minus the billings results in a negative amount, we have a liability in that we have billed our customer greater than the cost and profit we are entitled to date. And these are timing differences that will generally work themselves out over the life of a contract. And so it's nothing more than unearned revenue. The other balance sheet account involved in this, of course, is our accounts receivable balance, which is simply the billings to date, the increases in accounts receivable, less the cash collections. Let's take a look at some unusual accounts that are used in the percentage of completion method. In the percentage of completion method, we'll be using a variety of accounts to do our bookkeeping and reporting. The first one is an asset account called construction in progress. And this is like an inventory. Every time we have a cost for, say, labor, materials, subcontracting, as we incur those costs, we will increase this construction in progress as opposed to increasing an expense. So as we incur the cost, we increase the asset account. As we bill our customer, we have an accounts receivable. And we'll also have another account, since we're not going to be crediting revenue. We are going to be crediting for every dollar we bill our client. The other side of that entry is a credit to an account called Billings on Construction. This will be maintained for each job that a contractor has. So it, like accounts receivable, is made up of a number of subsidiary accounts, and it will be matched to a particular customer's job. The same is true with construction in progress, by the way. That also is job related. Billings on Construction is a contra asset against our construction in progress. So it's not a contra asset against the accounts receivable. Each period, we will recognize some contract revenue. And just like any revenue account, this is a temporary account that is closed out at the end of the year. We'll also be dealing with a nominal account, much like income summary, that lives only in the closing process, and it is called construction costs or costs of construction. And these have the actual costs that were incurred during the period. Remember, construction in progress is a permanent account for the length of the project. This construction costs is a nominal account that exists only in the closing process, and it is the amount of actual costs we had for that project during the period. It gets closed out in the closing process. For reporting purposes, we'll have two additional accounts: billings in excess of cost and profit. This is our liability account. Again, very similar to unearned revenue. There will be a account for billings in excess set up for each of our projects, and on our balance sheet we will total up all of our projects that have a liability associated with them and report one number on the balance sheet. We will have a similar asset account that is titled cost and profit in excess of billings. You can think of it like an inventory account. In the next part of our video, we'll be working through an example that's laid out in the textbook, but I'm going to use a different format, which is more in lines of the way I have always seen these percentage of completion contracts laid out, and how it was explained to me by controllers in the construction industry. So in our next video, we'll be taking a look at a demonstration project problem.